Auditing is best thought of as an activity. Yet, until this point, we've been thinking about auditing as a theory. At the highest possible level, we've been trying to evaluate how an auditor would conduct their work. But the auditor ultimately needs to audit accounts. And so what we're going to do is we're going to focus right now on how the auditor would look at revenue. And so as we can see why from this figure, one of the reasons why revenue is an important account is that is where one of the most common sources of fraud schemes. And so this figure here is from the Certified Fraud Examiners Association. So revenue cycles can take two forms. A cash sale involves purchases being made by the company where they change cash for inventory. It could also be services. The more complicated scenario is accounts receivable involves credit sales, where a company gives inventory to a customer for a promise to pay in the future, which then may or may not be made. And so both of these present unique audit challenges. Obviously, credit sales represent a more difficult audit because there's that additional steps. So the key questions we're going to ask as auditors: are the transactions properly executed? Are they properly recorded? Is custody properly maintained? And so what would be some ways the transaction wouldn't be properly executed? It's the goods are transferred before a contract. The price is not negotiated. Those type of issues. Properly recorded, prematurely recorded, recorded in the wrong period, recorded at the wrong amount. So we're basically going to have three types of transactions: sales transactions, cash receipts transactions, and returns and allowances. And so when we look at each of these transactions separately, we can start to picture the journal entry. A sales transaction is going to be debit cash or accounts receivable, credit sales. Cash receipts are going to be debit cash, credit accounts receivable, or debit cash, credit sales, if it was a cash sale. Returns are a little bit more complicated because we need to decide if the company has sales allowance or whether they're doing the direct method and reducing sales. And so, but it's important to bring this back to that 2303 accounting knowledge so that we don't get lost in the details. So when we think about this, we want to think about it in the different areas we've got. And so the inherent risk we're going to be concerned with is, what are the ways revenue can be manipulated? Cash sales are less commonly manipulated than credit sales. Certain industries have different practices, the complexity, misstatements, and prior audits. We're going to look at the controls. Does a client have good controls, weak controls, how they work? Then we're going to do some analytical procedures. We might look at the AR turnover. We might look at days and receivables. We'll look at those types of things to try and figure out how much risk there are so that we can determine the substantive procedures we need to do or the test of details we need to do. And the most common one there is confirmations, which we'll talk more about. But essentially, we're taking our audit risk model and we're taking a look at inherent risk, control risk, and doing some basic analytical procedures to determine the more expensive test of details. So when I say revenue manipulations, there's a whole variety. It could be early revenue recognition. It could be recognizing the revenue in the wrong period, completely fictitious sales, failure to record returns. That's a unique fraud because what it does is the goods that are returned, not only do we not reduce sales, sometimes we actually include the returned goods in inventory. So it has a significant impact. Percent complete method is a complex transaction, so based on assumptions and estimates, and so that's a form of manipulation. Related party transactions are always higher risk, overstating receivables and inventory, and omitting liabilities and expenses. And so I know your first thought might be, well, what liability or expense are we talking about? Well, we could be thinking about warranty expense. Sometimes when you sell goods, you make a commitment to provide service for those goods, which means the liability also needs to be recognized with the revenue. So we're going to take our first run of controls. First thing we're going to ask is, what are the controls? Do we understand them? So basically, we're focusing on the design of the controls. Then we're going to say, if the controls work as planned, does it make sense to reduce the control risk? If it doesn't make sense to reduce control risk below maximum, our control testing decision is pretty easy. We're not going to test them. If we can set it sufficiently low that it makes sense to test them, then we are going to have to design our tested controls. Now, it's not always an all or nothing. We may decide the controls related to receivables are effective, but not cash, or vice versa. So when we're thinking about the controls and we're evaluating whether it makes sense to test, generally speaking, the more transactions there are, the more often we're going to have to rely on controls. If there's only a few transactions, we can audit the entire population. But if the client, such as Walmart, has millions of transactions a day, we can't possibly audit them all. Then we'll look at the nature and complexity of the system. The more complex the system, the less inclined we are going to be rely on it. So the availability of evidence. And so when there's alternative evidence is readily available, we might be more inclined to go to it rather than test the controls. If the controls don't generate evidence, then it's unlikely we would test it. So for example, if a management override requires just a visual authorization, so you have to, an employee has to ask the management for permission to override. There is no documentation or password verification or anything like that. There's no evidence to test that the proper authorization was given, therefore we will not test that control. And generally speaking, the use of the internet requires more reliance on control testing as it's harder to get direct evidence. So we do want to pay particular attention to the functions we're going to want to separate when we start looking at our flow charts of organizations. We want to separate the authorization, the recording, and the custody of the assets. And for each cycle, and we're only looking at the revenue cycle here, you can actually take and narrow it down and go, here are the functions that relate to authorization. Here are the particular functions that relate to bookkeeping. Here are the functions that relate to custody. It's not worth memorizing any list like this because the case we give is not necessarily going to use these particular terminology, these phrasing. So for example, there might not be a person who is labeled as receiving orders for sales. It could be just the sales clerk. And so then we have to figure out what are the duties of the sales clerk. And they might say accepting orders for sales. And so you need to understand what that means. And so the main takeaway is what person has the ability to authorize the transaction, what person has the ability to record the transaction, and not just enter into the book, but maintaining the records, securing the records, and who has custody of the assets. And so that would be more the physical goods rather than the accounting records. So how are we going to test controls? Well, we are going to ask the client some questions. We're going to look at some documents. We're going to observe the controls in place. A walkthrough means we're going to take a transaction. We're going to see how it actually works. We may actually reperform some transactions to see how that works. And so setting control risk is going to be based on our tested controls. If we set it at maximum, we don't have to test the controls. But if we want to set it below maximum, we're going to need to gather evidence. Whatever we set control risk is going to determine our planned substantive procedures. Note the emphasis on planned. As we conduct our substantive procedures, we may need to adjust our audit. For example, if a procedure proves ineffective, we wouldn't just say, well, that's what we plan to do, and that ends the discussion. We're going to reassess the risk. We're going to reassess our plans to ensure we gather sufficient appropriate audit evidence. So we do want to pay particular consideration to returns. They're not going to be a material amount for most companies, but using credit memorandums and things becomes a higher risk area. So for example, if I've created a fictitious sale, I need to get it off the books. If I write off a large account, that would draw attention. But if I issue a credit, that would take the fictitious sale off the record while providing a clear story on why and perhaps avoid the typical scrutiny. So some of the substantive analytical procedures you could provide. Again, I wouldn't memorize a list, and as you do more and more problems and see different cycles, you'll notice there's always a list. There's a list of this and a list of that. And it's not a good strategy because to just try and memorize your way out. But for each of these ratios, can you pause this video and go through and say, what would it mean if this ratio were too high or too low? So if the receivables were turning over too quickly. That's not necessarily problematic. If they're not turning over enough, well, what would be a scenario that would cause receivables to fall? Well, that would be fictitious sales, because fictitious sales will increase sales, but they also increase accounts receivable. And what that means is we're going to have longer and longer time between people pay, because people who are fictitious never pay their bills. And so that's a warning sign when you see AR turnover ratio low. And so, but playing with the ratio really helps. So confirmations we haven't talked about yet, but confirmations, there's actually 3 types. You're expected to know a lot about confirmations. It's a frequently tested audit area. So the first type is called positive confirmations. These are when you send a blank letter to the client, not a blank letter, I apologize. It's when you send the detailed records of the company and you ask the client to positively agree or disagree. Meaning we need a response. We're going to keep asking them for a response until we get one. Negative confirmation says, we're going to assume this is correct unless you tell us otherwise. Obviously, positive confirmations is more persuasive evidence, because negative confirmation assumes the absence of disagreement means agreement, which isn't always true. The third type, which I alluded to, is called blank confirmations, where you simply send the client or the customer a blank sheet of paper and say, can you confirm this? Now, I do want you to dig into the standards on confirmations, because there's a lot of particular rules about confirmations that you need to pay attention to. For example, you cannot just get oral confirmation. It has to be in writing. You cannot receive fax messages. It has to be by mail. Some of these have unique histories, and I'll share in our discussions about those, but expect to be tested in detail on that. So some more details about confirmations to make sure you know. They have to be done close to year end or at an interim date. And so if you do them at an interim date, you're gonna have to do updating procedures. If you do them at year end, you're done. We're more likely to get a response closer to fiscal year end. The auditor must mail them directly. They can't even use the client's mail room. If the client touches them at all, if the customer returns them to the client, they're void and must be redone. We must review the exception. So the customer replies back and says, I don't agree with this amount. We got to figure out why they don't agree. Is it just a timing difference? Is there something going on? And we need to actually verify the client addresses, because it's been known for the auditor to even give us fictitious addresses, and it goes to someone in the leadership. So if we can't do confirmations, the person won't reply, we're doing positive confirmations and we just can't get a reply, we can look at subsequent cash receipts. If someone pays a bill, that's pretty compelling evidence they owed the bill. We could also look at shipping documents, shipping invoices, those types of things to get verification that the underlying transaction happened. Or we could look at that more generic other client documentation. It might be a contract, it might be, I don't know off the top of my head, that other category is meant as a catch-all. So at the end of the day, we're going to take all the evidence we've got. Now, we've made our assessment about controls. That may influence our opinion on internal controls. But at the end of the day, our opinion is on the financial statements. And so we are going to use the phrase likely misstatements less than tolerable. Sometimes when we do sampling, we have projections we make. And so we don't actually have an identified misstatement, but we predict, because of our sampling, that there's a certain level of misstatement. If that's less than the tolerable, we're going to say the account looks fairly stated. If our estimated misstatements or likely misstatements is greater than the amount we can tolerate, we can say the account is not presented fairly. Now, at that stage, we wouldn't just accept the results and move on. We would try and figure out, is there any way within professional norms we can reduce the likely misstatements? And when we do have the sampling module, we're going to go into some of the strategies you can use to ethically achieve that goal. So you're now fully versed in the background on the revenue cycle.